Hello and welcome to Pro Trader Strategies Market Commentary for Friday, February the 29th. No, it's not a leap year, sorry. Friday, March 1st. My name is Eric Wilkinson and some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, though, we are here to teach you some different strategies you can then implement into your portfolios, but please do that in your own way. Also, remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right, having that out of the way, let's get it on with some economic data. Yes, I think I'm going to have to start wearing some glasses so I can read the economic data. Anyway, part of getting old, I guess, or just bad eyes from staring at screens. I don't know what's making this all happen, but it's to a point where I think I need to start wearing some glasses so I'm not squinting on this thing all day long, all right? So let's talk about Japan. Consumer confidence came in at 41.5, expected to be 41.6. We got German retail sales coming in a lot better than expected at 3.3%, expected to be 1.9%, and they revised last month's number up from a negative, I think it was 4.3% up to a negative 3.1%. Negative 4.3% up to a negative 3.1%. All right. Then we also got some other manufacturing PMI numbers coming out of Europe. But remember, it's the same old thing we're seeing really is the manufacturing side not doing so well. It's not their flash estimates, so it's not really all that important. It's just very reflective of what we've already seen on the PMI numbers coming out of the flash estimates. But we did get Great Britain's manufacturing PMI coming in at 52, expected to be 52, no revisions to the previous month's number. And then European CPI flash estimate, remember this is Consumer Price Index, came in at 1.5%, expected to be 1.5%. And then core CPI, which strips out food and energy, came in at 1%, expected to be 1.1%, so pretty much in line with expectations there. Unemployment rate came in line with expectations as well at 7.8%. Here in the United States, we got personal income finally starting to move higher. We got it at 1%, expected to be 0.5%, and revised last month's number up slightly from 0.2% to 0.3%. We also got core PCE, which is personal consumption expenditures price index, came in at 0.2%, expected to be 0.2%. Last month's number revised up slightly from 0.1% to 0.2%. And then we also got personal spending coming in at negative 0.5%, expected to be a negative 0.2%. So worse than expected there. Last month's number revised up slightly from 0.4% to 0.6%. So the revision does help out that number, making it come in line a little bit better. But we are seeing that, like we said, the income numbers being a little bit, or the price index came in better. GDP came in, that's Canadian GDP. What was it? That personal income came in a little bit higher. And then that was for the United States. I don't know why that was month over month. Sorry, month over month, week over week is the other one that we're getting here. And that one is coming in slightly lower than expected at negative 0.1%, expected to be a positive 0.3%. We also got final manufacturing PMI, Purchasing Managers Index, coming in above 50 is expansion, below 50 contraction. We got a 53 reading. It was supposed to be 53.7, so pretty close to in line there. ISM manufacturing PMI came in at, which is the Institute for Supply Management. This is the one that we really want to look at. Comes in at 54.2, expected to be 55.6. Revised University of Michigan Consumer Sentiment, 93.8, expected to be 95.8, slightly lower than expected there. And then we got the ISM, Institute for Supply Management, manufacturing prices coming in below 50 at 49.4, expected to be 51.6. Remember, last month's number was 49.6. That's 2 months in a row we've had below a 50, which means prices are coming off for those manufacturers. They're not seeing higher prices, which would be above 50 readings. So 2 months in a row, we're seeing lower readings there. That probably not going to be passed on to the consumer on those lighter prices there. They're going to have better margins though. And then total vehicle sales throughout the day. And I always say, if you're going to be on Twitter, or if you are on Twitter, follow Phil LeBeau, because he does a great job of covering all of that stuff. All right, on to the overall markets. We've got crude oil coming off again today. We had that 11 million barrel drawdown, more than expected. I was expecting this to start pushing higher into the 60s, but it just seems to be an opportunity right now for some people that were long down in those 40s to cover some sizable positions, which is causing this to come off a little bit. Is the only thing that I can wrap my head around as to why this market is showing weakness with the lack of supply in crude oil. I mean, we still have a lot of supply, but just a huge drawdown would generally cause this market to push higher, I would expect. And then on to gold futures. Gold's continuing to have a bad day. The last several days, we've just seen massive sell-offs in gold futures. You can see it's wanting to go down and test that 13 handle and peel back into the 1200 handle. That's what I've been expecting for quite some time. I didn't really expect it to push this high, which is, the mandate for any market, right, is to push further than anybody expects, to kind of put on the most pain that they can. And that's what happened with gold, but now it's starting to really lose its luster. Bonds also losing some steam here. You would think that a lot of these things, these flight to safety, safe haven assets like gold and the bonds would sell off. That would cause the equities to push higher as you're putting money into the equities as they move higher. But we're not really seeing that push higher in equities, which is a bit of a conundrum right now. But the bonds coming off, we're not expecting to see interest rates go higher. All right. If interest rates go higher, then bond prices go down. I don't expect interest rates to go any higher. I don't expect them to go any lower, to be quite honest. So that being said, bonds are probably priced in and around pretty close to where they should be for the better part of the year, unless something really starts happening to put a kink in that. So VIX, let's take a look at that. VIX is unchanged for the most part, a little bit negative on the day, but that being said, we would expect the VIX to start pushing higher. The levers and pulleys of the markets just don't seem to be coming to fruition today, with the Dow Jones Industrial Average still having a messy chart set up, as you can see here. Not a whole lot to see, pretty much back and forth every single day, and I can't get a discernible direction out of any of these. We just have counter-opposing dojis every single day. Too many of these, or several of these in a row, does make it look like a continuation pattern to me. But we're not seeing that push through. When we're seeing the gold come off and bonds come off, we should really see equities start to push higher. But it looks like a lot of people are putting money in or putting their portfolios into cash right now, because of these levers and pulleys that aren't really kind of coming through the way we would expect. With the Dow Jones Industrial Average going into positive, up 20 on the day. And then we've got the the E-mini S&Ps here, slightly higher on the day, as you can see. What's that last one, the NASDAQ? Because I don't know why I don't have the NASDAQ trade up here. The NASDAQ is in positive territory, as you can see. But again, all of these counter-opposing dojis across the board. E-mini S&Ps looks very similar. Now let's take a look at the daily chart. This is each day section is highlighted in this blue area. Each candle is a 30-minute. And you can see the market overnight really got pretty long, flushed those guys out on the economic data, which, everything was lower than expected. That's even though we saw these PMI numbers above 50, which is expansion in the economy. Anything above 50 is expansion. Anything below 50 is contraction in the economy. We're seeing expansion going on, but lower than expected coming in on those readings really caused the overall market to kind of shudder. And we've seen that sell-off, flushing out basically all of the longs right into and around where we opened for the most part. Slightly positive on the day, but all in all, not looking too good for the equities today, I don't think. All right, that's about it. I haven't added anything. We just have such low implied volatility across the board. Even some of the ones that have earnings are looking like they are below 50. And I have so many things in my portfolio already that are buying options, which I don't love to do. I don't want my entire portfolio like that. I'm trying to find some ways to throw in some negative deltas, not negative deltas necessarily, but short selling naked strategies or selling options to collect that premium, like I did with GDXJ yesterday. GDXJ isn't really reacting the same way we saw it with the gold coming off. You would expect the miners to come off as well. We're just not seeing that happen right now, but I would expect the follow through to happen with those as gold continues to sell off. And that's all I've got for today. I'm going to keep trying to grind here and find something to add, but as of right now, it's just nothing is really sparking my fancy anyway. So follow me on Twitter at Wolfman's blog. I'll tweet out anything if I do anything today. So keep your eyes out for that. That's all I got. I hope everybody has a great weekend. And if you can't take that, take it easy.